What is happening, crypto fans, and welcome back to Bitcoin Bulletin, the only show that cuts through the noise and gets you the real story. The market is absolutely electric right now, a total whirlwind of action, and if you're not plugged in, you're missing out on some of the biggest moves of the year. We've got charts flashing red, massive whale transactions, and institutional players making bold predictions. Get ready, because we're diving deep into the data, breaking down the sentiment, and telling you exactly what you need to know to stay ahead. First up, is the party over or just getting started? Bitcoin and Ethereum are showing us some seriously mixed signals, and a massive whale sell-off has sent shockwaves through the entire ecosystem. We're talking about charts that tell a story of weakness, but also resilience. What does this mean for your portfolio? We've got the breakdown. Then, we're zeroing in on Bitcoin's critical $105,000 lifeline. It's become the ultimate battleground for bulls and bears. With liquidations soaring and synchronized selling across all wallet sizes, this level is more than just a number. It's a line in the sand. We'll explore the onchain data, the seasonal patterns, and the whale activity that's making this a must-watch moment. But wait, it's not all doom and gloom. Even with the volatility, some big players are doubling down on incredibly bullish calls. We'll look at one firm that's sticking to a sky-high year-end target. What's fueling this conviction, and can Bitcoin really reach those astronomical levels despite the current choppiness? And finally, we're diving into the engine room of institutional demand, Bitcoin futures. We'll dissect what's driving this surge, how volatility is playing mind games with traders, and the crucial risk management strategies you absolutely need to know. Plus, we'll cover the evolving regulatory landscape and what it means for the future of crypto trading. Stick around, hit that subscribe button, ring the notification bell, and let's get this episode started. Mixed signals emerge as Bitcoin and Ethereum charts show divergence. The cryptocurrency market has kicked off the week with a significant downturn, marked by a substantial Bitcoin sell-off orchestrated by a large whale, which subsequently triggered a cascade of liquidations across numerous leveraged positions. This event serves as a stark reminder that even the most meticulous chart analysis can be swiftly overturned by unforeseen market forces, often termed black swan events, or, in this instance, a big red whale, capable of instantly reshaping market dynamics. Just a few days prior, Federal Reserve Chair Jerome Powell's remarks at the Jackson Hole Symposium had ignited optimism, opening the door for potential interest rate cuts and sending risk assets, including cryptocurrencies, soaring. However, this sentiment proved fleeting. The total market capitalization of crypto has since plummeted, experiencing a 2.4% decrease in 24 hours, settling at $3.83 trillion. The dramatic $2.7 billion dump over the weekend has profoundly impacted Bitcoin's price action, revealing signs of weakness for the first time in a considerable period. Intriguingly, Ethereum, the second largest cryptocurrency by market cap, appears to be demonstrating greater resilience amidst this turmoil. The massive Bitcoin sell-off drove its price down to a critical support zone near $113,000, resulting in the forced closure of over $846 million in leveraged positions, predominantly affecting optimistic long traders. Bitcoin commenced the trading day at $113,491, but rapidly declined to a low of $110,584 before stabilizing at $112,429. This represents a 0.92% drop for the day and a more than 2% decline over the preceding 24 hours. The flagship cryptocurrency briefly tested the psychologically significant $110,000 support level, managing to rebound before automated selling by algorithmic traders could intensify. Technically, the picture for Bitcoin suggests a loss of momentum. The average directional index, ADX, a measure of trend strength, stands at a weak 16, well below the 25 threshold indicative of a strong trend. Readings below 20 typically signal choppy, directionless market phases, making them susceptible to sharp moves driven by FOMO, fear of missing out, and FUD, fear, uncertainty, doubt. The Relative Strength Index, RSI, currently at 42.48, has dipped into bearish territory. Readings below 50 indicate selling pressure outweighs buying interest, and a level near 30 suggests oversold conditions, potentially signaling short-term buying opportunities, though caution is advised. The squeeze momentum indicator shows an on status, implying that volatility compression is building, which, combined with the weak ADX, typically suggests an impending significant directional breakout. However, the current price action hints that this breakout might be to the downside. On the longer-term horizon, Bitcoin's exponential moving averages, EMAs, present a more bullish outlook. The cryptocurrency is trading above its 200-day EMA, a key indicator for many traders, though the gap is narrowing, suggesting a slowdown in bullish momentum. A breach below this level could trigger systematic selling from funds programmed to exit positions on trend reversals. Market sentiment has visibly shifted, reflected in prediction markets where confidence in Bitcoin reaching $125,000 has waned, with a greater probability now assigned to it dropping to $105,000. Meanwhile, Ethereum, despite a sharp rejection from its recent all-time high of $4,946, shows stronger technical indicators. Its ADX at 41 indicates powerful directional movement, and its RSI at 58.97 remains in neutral territory, suggesting room for further growth. The squeeze momentum indicator suggests that the market has already experienced its major move, potentially entering a consolidation phase. The EMAs for Ethereum remain decisively bullish, with the current price trading well above them. Don't go anywhere, the market's volatility is just heating up. Next, we'll dive into Bitcoin's critical $105,000 support level and what it means for the ongoing battle between bulls and bears. Bitcoin's $105K lifeline becomes ultimate battleground as whale sells $2.7 billion. Bitcoin has experienced a significant downturn, falling below the $110,000 mark and triggering approximately $880 million in liquidations. This sharp decline, driven by substantial whale activity and a shift in market sentiment, has pushed Bitcoin to a 6-week low. The drop occurred despite a brief rebound fueled by optimism from the Federal Reserve's Jackson Hole Symposium, which had previously propelled Bitcoin to $117,300. However, the positive momentum dissipated over the weekend, leading to a reversal and a low of $110,600 by Monday. A bearish weekly engulfing candle on the Bitcoin chart further underscores the increasing downside pressure. On-chain data from Glassnode reveals a concerning trend. All wallet cohorts have entered a distribution phase, meaning holders are selling their assets. This distribution is being led by mid-sized holders, specifically those holding between 10 and 100 BTC. This synchronized selling behavior across different wallet sizes indicates a broad-based bearish sentiment in the market. Analysis from trend accumulation data shows that while smaller holders, 0.1 BTC, have been accumulating since the recent peak, and 110 BTC wallets resumed buying below $107,000, the 10100 BTC wallets turned net sellers once Bitcoin surpassed $118,000. The 101,000 BTC cohort remains divided, with some accumulating and others distributing around the $105,000 level, highlighting this price point as a critical support level before a potential major correction. Bitcoin's realized price data further corroborates the significance of these levels. The realized price for short-term holders, 1 to 3 month cohorts, is around $111,900, while longer-term holders, 3 to 6 month and 6 to 12 month cohorts, have much lower cost bases, at $91,630 and $89,200, respectively. This significant divergence indicates heavy short-term positioning near recent highs versus the positions of longer-term holders. Analysts are cautioning that a break below $105,000 could accelerate the downward momentum due to a lack of substantial cost support in that price range. Adding to the bearish backdrop are seasonal factors and a potential ETF fatigue. Historically, August and September have been periods of weakness for Bitcoin, with an average decline of 21.7% during the so-called ghost month. The current pullback aligns with this historical pattern. Analysts also point to a weakening in organic demand, citing the absence of sustained enthusiasm for Bitcoin ETFs and a failure to reach new all-time highs against the euro since 2023. Furthermore, large whales continue to be active sellers. One whale alone offloaded 24,000 BTC, valued at $2.7 billion, over the weekend, exacerbating the flash crash. The impact of the liquidation event was severe, with over $300 million in positions lost within a single hour, predominantly affecting long positions, which accounted for 90% of the liquidations. This market downturn has dragged most altcoins lower, including Ethereum, which had briefly touched a new all-time high near $5,000 before retreating. Analysts are closely monitoring whether Bitcoin can stabilize above the $113,500 $114,000 range, as stabilization here could signal a potential resumption of the upward trend. Can Bitcoin hold its ground, or is a deeper correction coming? Next, we'll see if institutional conviction is enough to push Bitcoin to new heights despite the recent turbulence. VanEck reaffirms $180K Bitcoin target amid market volatility. Despite a recent pullback in Bitcoin's price, investment firm VanEck has reiterated its bullish outlook, maintaining a year-end target of $180,000. This reaffirmation signals that a segment of institutional investors remains committed to Bitcoin, undeterred by the current market fluctuations. Evidence of sustained institutional interest is further supported by reports of significant accumulation in July, with exchange-traded products acquiring 54,000 BTC and digital asset treasuries adding 72,000 BTC. VanEck initially presented its optimistic forecast in November 2024, when Bitcoin was trading around $88,000. Concurrently, US-listed miners have increased their share of the global Bitcoin hash rate to 31%, up from approximately 30% earlier in the year. This institutional accumulation is occurring even as the broader equity market, excluding specific outlier performances, has seen a decline. Bitcoin's price action has been dynamic, experiencing a slide to $112,000 in early August, followed by a surge to $124,000 on August 13, setting a new all-time high above the previous record of $123,838 in July. At the time of writing, Bitcoin is trading near $115,000, approximately 8% below its recent peak. Traders often interpret such pullbacks as repositioning following a rapid ascent rather than definitive breakdowns. Derivatives market metrics further bolster the picture of increasing speculative interest. CME basis funding rates have surged to 10%, the highest level observed since February 2025. In the options market, call-put ratios have reached 3.21x, indicating strong demand for call options, the highest since June 2024, with investors committing $792 million to call premiums. Despite this bullish sentiment, implied volatility has compressed to 32%, significantly below the one-year average of 50%, making options more affordable for buyers. Futures open interest remains robust, exceeding $6 billion, although a $2.3 billion reduction in open interest during recent corrections represents one of the larger single-session unwinds. Industry executives and analysts offer varied perspectives on the market's trajectory. Coinbase CEO Brian Armstrong, alongside figures like Jack Dorsey and Cathie Wood, has projected Bitcoin could reach $1 million by 2030, citing increasing regulatory clarity and widespread institutional adoption as key drivers. Conversely, Galaxy Digital's Mike Novogratz suggests that such a milestone might be indicative of severe economic stress in the U.S. rather than purely organic market strength. Preston Pysh has raised concerns that the growing influence of Wall Street could potentially alter Bitcoin's core use case and culture. From a technical standpoint, many analysts consider the $100,000 $110,000 range as crucial support. A decisive break below $112,000 could lead to price declines towards $110,000, with a more significant drop, potentially testing $105,000. The current market narrative is mixed. Strong institutional demand and speculative derivatives activity are pushing prices upward, while the affordability of options due to compressed volatility makes bullish bets more attractive. Ultimately, whether Bitcoin can achieve VanEck's ambitious $180,000 target will hinge on sustained inflows and the ability of key support levels to hold. Will the bulls or bears win this crucial support battle? Stick around as we break down the intricate world of Bitcoin futures and the strategies you need to navigate them. Bitcoin futures, navigating demand, volatility, and risk in a dynamic market. Bitcoin futures have emerged as an indispensable instrument for traders seeking to navigate the inherent volatility of the cryptocurrency market. With a notable increase in institutional demand, understanding the forces shaping Bitcoin futures trading is paramount. This analysis delves into the catalysts driving this demand, the psychological factors influencing trader behavior, and essential strategies for mitigating market fluctuations. Institutional investors are increasingly utilizing Bitcoin futures as a tool for hedging risks and gaining exposure to the cryptocurrency sector. This trend is fueled by the need for more robust hedging options and a desire for enhanced liquidity within the crypto space. As more funds and corporations embrace Bitcoin futures, a consistent demand is anticipated, even during periods of price instability. The growing interest in Web3 business banking also contributes to this trend, as companies seek to integrate cryptocurrency into their financial strategies. Volatility is an intrinsic characteristic of the cryptocurrency landscape, and Bitcoin is no exception. The demand for Bitcoin futures is intrinsically linked to market volatility, as traders aim to capitalize on price fluctuations. However, this volatility can also trigger significant emotional responses among traders, impacting their decision-making processes. Understanding the psychology of traders, particularly the influence of fear and greed, is crucial for comprehending market movements in Bitcoin futures. The regulatory framework governing Bitcoin futures is evolving, with different jurisdictions adopting varying approaches. While some regions are embracing cryptocurrency trading, others are implementing stringent regulations. Clear and consistent guidelines are vital for fostering a robust Bitcoin futures market, as they can encourage greater participation and improve liquidity. As regulators work towards establishing unified rules, the pathway for institutional players in Bitcoin futures trading appears to be widening. Given Bitcoin's inherent volatility, traders and small to medium-sized enterprises, SMEs, must implement sound risk management strategies. Key strategies include diversification to cushion against price shocks, maintaining disciplined position control by risking only a manageable percentage of trading capital per trade, and utilizing auto-exit orders, stop-loss, and take-profit to remove emotional decision-making. Cautious use of leverage is advised, employing just enough to manage typical market swings without overextending. Furthermore, diligent monitoring of margin ratios and liquidation prices is essential for making informed position adjustments. Employing trading bots and technical analysis tools can also aid in executing data-driven trades and reducing emotional biases. As Bitcoin futures gain prominence, a comprehensive understanding of the interplay between demand, volatility, and regulatory landscapes is crucial. The outlook for Bitcoin futures trading appears positive, supported by institutional backing and the development of innovative financial products. However, navigating this market successfully will require skillful management of market quirks and a steadfast commitment to risk management principles. Adaptability in the ever-shifting crypto world will be key for those aiming to succeed in Bitcoin futures trading. We've covered the charts, the whales, and the institutions. What's next? Stay tuned for a rapid-fire recap of today's top stories and a full call to action. All right, everyone, that's a wrap on another explosive episode of Bitcoin Bulletin. We saw Bitcoin and Ethereum facing mixed signals after a massive whale dump. Bitcoin's $105K level is now the key battleground for bulls and bears. VanEck is sticking to its $180 K target despite the pullback, and we took a deep dive into Bitcoin futures, demand, and risk management. Don't forget to smash that like button if you found this valuable, subscribe for more market-moving insights, ring that notification bell so you never miss an update, and let us know your thoughts in the comments below. You can also follow us on all social media platforms for real-time updates. See you next time.